Hello and welcome. You're watching NDTV Profit, and today we are joined by two very special guests, Mr. Shirish Godbole and Mr. Quaiser Parvez from Knowledge Realty Trust. The trust, one of Asia's largest real estate investment trust, has just announced the price band for its initial public offering. The price band is set at 95 to 100 rupees per share, and the IPO bidding for retail investors is expected to open on 5th of August. Gentlemen, thank you so much for joining us.
Thank you for having us.
Right.
Thank you.
So to begin with, as one of, like I said, Asia's largest real estate investment trusts with with 29 assets under your name, do you think India's REIT market is mature enough for an offering like yours, particularly if I speak from a retail investor's point of view?
Yeah, I think the answer is it's maturing, right? So I think compared to 2019 and Embassy coming along and having the first REIT, was clearly, a market that had to mature at that point. But today, investors are very savvy. You see the amount of retail participation in the stock market as a whole. I think the product is getting, understood better. Of course, we need to continue to educate the retail customer more, and I think familiarity will increase over time. But I think it's a more mature market today, we're very comfortable with whatever interactions we have had with HNIs or other individual investors who completely understand the product.
Right. So
I think in addition to that, what's also important is that the recognition of the product has sort of changed dramatically over the years. Where REIT was not really a well understood product. Now it is really understood to be a cusp of fixed income and equity, and I think that's a big sort of leap from where we the REIT as a product started in 2019 to now.
Right. So again, I've been throwing around the word one of Asia's largest REITs, but if I ask for some gravity to pull it down, can you tell us what assets you have, which geographies you're spread across?
Yeah. So we are truly, in some ways, the most geographically diversified REIT in the country. And why I say that is because with 46 million square foot, under management, spread over 6 cities with 29 assets, we are diversified. But what's also important that we are concentrated for stability in the top performing office markets of India, and that's Hyderabad, Bangalore, and Mumbai. Very poetically, our sort of value is split a third in Bangalore, a third in Hyderabad, and a third in Mumbai, and that's a significant sort of balanced portfolio which we have as we compare to anybody or any of the listed peers.
Also, I think I just want to add that in terms of diversity, there's also a tenant diversification point, right? Because today, global capability centers is something that a lot of people have read about, heard about. And that is the most active tenant in India. However, 29% of our space is actually targeting front office tenants. And what we mean by that is city-centric locations where the tenant is looking at transactional activity, whether it's consulting, whether it's banking, whether it's legal activities like that, sales in city-centric locations, right? And compared to others, in our competitive set, we have the largest amount of front office space, city-centric space of 29%. So that's also diversification because it's a tenant diversification standpoint, right? So it's not just one type of tenant, but a diverse type of tenant that makes up our profile completely.
Right, and when we talk about assets under your REIT, there is a right of first refusal deed signed with one of the sponsors, Satwa Group. So can you tell us what assets have been identified under the ROFO deed and when can they come into the REIT?
Yeah.
So we have 4 assets under the ROFO, which sort of cumulatively adds up to about 7 million square foot over 4 markets. 2 of the markets we are already existing in and 2 of the newer markets. But all of these assets are under varying stages of construction, and we expect the ROFOs to really sort of start formalizing in some shape and form post FY28 onwards.
Right, and when we talk about ROFOs, we'll also talk about cash flow. So currently, what does the net distributable cash flow situation look like for you guys, and how frequent are the distributions over a year?
So our distributions, just like anyone else, is quarterly. We're distributing 100% of the distributable income. But the way we look at this is FY27 is the stabilized year, and that's when our NOI is about 4,800 crore, and NOI is increasing by 13%, and which consequently has an impact on NDCF, which is increasing by 9%.
So
So
NOI,
7.2% yield stabilized first year, goes up to 7.7, and then goes up to 8.2, thanks to the 13% growth that Quaiser pointed out.
right? So with the underlying NOI growth, there's going to be an NDCF
NDCF
growth
absolutely,
as well.
absolutely.
And NOI is expected to grow to over 5,000
5,500
crore by
crores.
FY29. So is that going to be all organic or?
So that's all organic. In fact, the big levers of this growth is actually embedded. The big three levers which is coming through is through contractual escalations, rental resets, and lease up of the vacant area. Another big tailwind in our business is the mark-to-market opportunity, and we have 23% mark-to-market opportunity, and that's sort of contributing a reasonable number into this NOI bridge.
Right.
And
when
so mark-to-market, just to explain, is the existing rental rate versus the market rental rate, right? So 23% is a big gap. And the opportunity as our leases mature is to climb up to the market rent. And that is a huge growth and upside potential for us.
And what enables you to have that kind of a difference in the mark-to-market?
Well, I think some of our leases have been long. And so when you sign long leases, what happens is you tend to therefore sign at older, lower rents. And if the markets have appreciated in the last 3 years as they have, then that presents the opportunity for that mark-to-market.
Another reason which sort of to add to that is the fact that we have a standard lease expiry profile of about 1.5 million square foot every year. And that just gives us a natural uplift on all the leases which is sort of expiring to get ourselves to reset to the market, to probably the mark-to-market.
Right. My next question again, I would like to ask on your new assets. So will there be, what kind of capital requirement would there be? I know you mentioned an amount for the ROFO deeds mentioned with the Satwa partner, but what kind of capital requirement will it need from Knowledge Realty?
Yeah, so just to add there, today we're beginning post the IPO with a 19% LTV, which is very low. Comparatively, right? And what that allows us to do is to lever up the portfolio. And so we intend to go from 19 to somewhere 30 or sort of low 30s. But that is, more than 7,000 or 8,000 crores of debt that we can take on, right? And of course, we can also issue units. So if there's a prospective seller, we can issue units as well. So between the two, we have significant liquidity, we feel, in terms of funding the acquisitions going forward.
Right, so either a unit issuance or through debt.
Which is cash, basically. Generate cash through debt.
Right, and again, how will, you talk about new assets, how will distribution yield be affected, say, by FY29? Where do you see your distribution yield at?
Our distribution yields will be, in FY19 will be 8.2%. On an average in the last 3 years from FY27, our average yield will be 7.7%.
And also, what kind of, because a large part of your IPO funds will go into debt reduction.
Yeah.
So what kind of a trickle-down effect will that hold for a retail investor like me? Will my yield go up? Will I see more returns from my...
So the way to look at this, we have been fairly conservative in our approach with interest rates. In fact, as of today, while the sort of recent refinancing has happened at fairly steep sort of numbers, we have left a cushion of about 50 to 80 basis points of interest rate resets cushion in our cash flows.
So that if we are able to lower rates, which we will in the next few months, that'll trickle down fully to the NDCF, and that'll also add to our NDCF, and that's not sort of factored into the 13% growth we talked about, right? So that's further potential.
So there's
available.
more potential for...
Yes.
Also, I would like to touch upon the fact that there's been no ROFO deed signed with Blackstone, which is a bit counterintuitive if you ask me, because for a private equity which has a lot of assets, lucrative assets for a REIT like yours, only one sponsor is there to deliver assets going forward.
The Blackstone is a private equity fund. The fund has a lot of regulations and restrictions within which they have to operate. They have a lot of limited partners who invest with them. And so as part of that, it is very customary that they cannot really give out a ROFO. And it's part of their overall fund arrangement. So it's nothing to do specifically with us. If they could have, they probably would have. but they can't do it, and which is why we haven't got a ROFO asset from Blackstone. Having said that, Blackstone is obviously a sponsor here and fully behind the transaction, and to the extent there are opportunities where we can work together in acquisitions and adding to our portfolio, I'm sure Blackstone will be behind us completely.
Right. So lastly, I would like to ask you on a more wider angle a question about where do you see the commercial real estate demand going ahead in India? And I know that there will be 7 assets that you said that you will be adding till FY28-29, but is the demand going to sustain beyond that? What do you guys think?
Yeah. So I mean,
Yeah.
I'll answer and then you can chip in.
Sure. So I think the way we look at this that the office demand in India is very structural and it's not very transitory. And the reason why we say that, in the last couple of years, each passing year has kind of surpassed the last year. Right? If you just look at 2024, it's 79 million square foot of absorption, and that's about 16% year on year. Right? And if you just look at the H1 of 2025, you're already in the zip code of 48 to 50 million square foot. And why we think it is structurally sort of sound and here to stay is, I think the big demand driver, if you look at the GCCs, which largely accounts for like a third of leasing in India, that whole transition has moved from just a cost arbitrage to a capability arbitrage, because people have started focusing on what India has to offer, not just the 17, 18 or the 20% sort of difference on the real estate cost, but what it really has to offer in terms of talent, in terms of location, in terms of the asset quality and so on. So I think the whole sort of rush hour in office is here to stay.
I'll just add to that, and I think COVID was a very important phenomena in this aspect, and I'll explain why. Because what happened in COVID is a lot of people around the world got comfortable doing business, doing work online. And once you get that comfort, especially as you go west, as you may know, a lot of people still don't go to their offices every day, right? So a lot of work actually gets online anyway, gets done online. And so once you're getting comfortable using and getting work done online, whether that person is 50 kilometers away from you or whether they are 5,000 kilometers away from you, honestly doesn't really make a difference. And so therefore, as QP was pointing out, there is a skill set available in India which in abundance is not available as much in the West. So when you look at the cost at which that skill is available and the fact that people are used to working online, makes why India GCCs are working, because the quality is there and the distance no longer matters. That's the answer to your question.
And I know I said this would be my last question, but on a final note again, I would like to ask about the kind of space you are entering. You are entering into a listed market with other REITs, and most of them are again backed by a common sponsor. So what unique proposition is it that you guys bring to the table that I, as a retail investor, can come in with enough confidence of a growth story?
I think a couple of them. Number one, I think we were truly sort of diverse in our location and more so extremely balanced. So sort of that gives a resilience to our business. Number two, we have the highest occupancy. Just on operating metric, we are like 91% occupied. Number three, I think given the fact that we are the only ones to have a city center portfolio, more fundamentally about 5.5 million square foot of front office between Mumbai and Bangalore. But I think the big one for us is the fact that we have the lowest SEZ exposure in our portfolio, and that's just about 14%, and that what translates to about only 2 SEZs in our portfolio, and that to a 90% occupancy and a veil of 15 years. That, I think, bundle up all together is a big distinguishing factor, clear lines of difference, and add that to our NOI sort of growth plans of 13%, roughly about 80 to 85% is kind of embedded into our business model, really makes us very, very different.
Just again, one addition there, to a retail investor, it's actually quite simple, we have the best located assets. And in real estate, it's all about location, 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 right? And so if you've got some of the locations we have and the assets we have, I think that's the biggest difference here.
Right, gentlemen, that was my last question. Thank you so much for taking the time. You've been very grateful and gracious in your answers. Ladies and gentlemen, that was the management of Knowledge Realty Trust talking to NDTV Profit. Stay tuned for more updates.